Stop what you're doing right now. Seriously, if you own any travel or leisure stocks, you absolutely need to see this 5-model valuation breakdown. Welcome back to another Explainer, where we take deep, complex financial data and turn it into clear, actionable insights.
So get this. Last week, I ran a company called OneSpaWorld through 5 rigorous financial models and 2 legendary investor checklists. And honestly, what I found completely shocked me. We're talking about a deeply under-the-radar company that's basically operating quietly in the background of some of the most famous vacation brands on Earth. It's wild.
I mean, check out this number. This company's net income just skyrocketed 40% to $21.3 million in the first quarter of 2026 alone. And this happened right while the broader market was literally panicking about consumer spending and a potential travel recession. Think about that for a second. While everyone else is bracing for a downturn, OneSpaWorld is posting its 20th consecutive quarter of record total revenues and adjusted EBITDA. Their intrinsic value could actually be drastically higher than what the market is pricing in right now.
So, I really have to ask, are you missing out on the biggest hidden moat at sea? Because OneSpaWorld is essentially a floating toll booth for luxury spenders. They have exclusive contracts to operate the health and wellness centers on over 200 global cruise ships. Guys, that's over 90% of the entire maritime wellness market. And the absolute craziest part? They don't even have to pay to build the spas. The cruise lines foot the bill for all the heavy construction. It's genius.
By the end of this explainer, you're going to know exactly whether OSW is a Warren Buffett buy, a Peter Lynch trap, or your next portfolio anchor. Look, we've all been there. Retail investors often buy at the absolute top of the hype cycle, right? You chase the latest tech trends, feel the FOMO, and ultimately get burned when the bubble pops. It's a massive pain point. But instead of guessing, I'm going to give you the clear, actionable 5-model framework I use today, so you can literally steal it for your own stock analysis. All right, let's dive right in.
Section 1. The floating monopoly. Let's look at this capital-light cash machine.
Okay, so this is the absolute definition of a capital-light business. Basically, OneSpaWorld holds these exclusive multi-year contracts with the true heavyweights of the sea. We're talking Carnival, Royal Caribbean, and Norwegian. When these massive cruise lines build a multi-billion-dollar ship, they obviously build a state-of-the-art spa to go with it. But here's the kicker. OneSpaWorld just walks right in, staffs it, and operates it. Boom. Zero construction capex for OSW. This asset-light framework means the cruise lines are literally footing the bill for OneSpaWorld's physical expansion. It gives them a near monopoly without the massive real estate costs that your typical land-based gyms or salons have to deal with. And operating on 208 ships globally, that means they control over 90% of the maritime wellness market. Talk about a moat.
Moving on to Section 2, Q1 2026 earnings and that incredible growth engine. The momentum here is just undeniable. Top-line revenue increased 13% year-over-year, jumping from $219.6 million to $247.6 million. This completely validates that their growth engine is firing on all cylinders. And remember, this isn't just some lingering pandemic bounce back anymore. No, this is sustainable, structural growth.
So, where exactly is all that extra revenue actually coming from? Well, the biggest chunk, $23.1 million, comes directly from new ship builds. Every single time a new ship hits the water, OSW gets a guaranteed brand new revenue stream. It's automatic. But really look at that $5 million jump for higher guest spend. That's super interesting. They are rapidly rolling out these high-margin media spa services. Think IV therapy, TrueFlex muscle sculpting, Thermage, you name it. The guests are a completely captive audience on a luxury vacation, they're feeling good, and they are totally willing to spend premium prices on advanced treatments. They've effectively taken traditional massage parlors and turned them into high-tech medical aesthetic centers at sea.
All right, Section 3, the 5-model valuation breakdown. Let's get into the financials. Now, before we look at the raw numbers, let's briefly define one of my absolute favorite tools, the Piotrowski F-score. If you haven't heard of it, this is a rigorous 9-point scale used by value investors to evaluate a company's financial health, profitability, and operating efficiency. For us retail investors, seeing a high score here means absolute fundamental strength. Basically, a score of 8 or 9 is pristine. It's what you want to see. Let's see how OSW stacks up.
All right, here's the gauntlet. Let's rapid-fire walk through these metrics. First up, an Altman Z-score of 10.07. To put that into perspective, anything above a 3 is considered perfectly safe. So a 10? That mathematically proves exceptional financial stability with near zero bankruptcy risk. It's rock solid. Next, that Piotrowski F-score we just talked about, it's an 8. Near perfect. That indicates pristine operational health.
They're also trading at a forward PE of 20.59, which honestly is a very reasonable multiple when you look at their massive earnings growth. Their return on invested capital sits at a really impressive 14.11%, and we can directly thank that asset-light model we talked about earlier for that one. Finally, a free cash flow yield of 2.69%, showing really healthy cash generation that they use for dividends and buybacks. The math just doesn't lie here, folks. This is a fundamentally robust cash-generating business.
Section 4. Legendary Investor Checklists. Let's put OSW up against Warren Buffett and Peter Lynch.
Okay, so OSW fits Buffett's criteria almost perfectly. Does it have a capital-light business model? Yes, absolutely. Wide economic moat? For sure. They have a 90% market share. High return on invested capital? Yes, again, at over 14%. Buffett literally loves monopolies that don't require massive capital expenditures to grow, so this hits the nail on the head. Now, what about Peter Lynch? His famous mantra was, buy what you know. Is this easy to understand? Yes, it's literally spas on cruise ships. Pretty simple. Does it offer growth at a reasonable price, or GARP? Yes, it does. With EPS expected to grow a staggering 68% in 2026, that forward PE of around 20 looks incredibly attractive. Honestly, it passes both legendary checklists with flying colors.
I love this quote from the Koala Gains analysis. OSW has significant pricing power due to its captive audience, effectively locking out competitors from over 90% of the maritime wellness market. Think about that for a second. When you're on a massive cruise ship in the middle of the ocean, you can't exactly just walk down the street to a cheaper spa, right? That captive audience on a luxury vacation gives OSW elite pricing power. And as we know, pricing power is the ultimate hallmark of a truly great business.
And finally, Section 5, the final verdict. Let's weigh the bull case against the bear case.
Now, it is absolutely crucial to present both sides fairly here. On the bullish front, there are incredible tailwinds. There's really clear visibility, with over 50 new cruise ships scheduled to be built through 2028. Plus, they're rolling out an AI-driven dynamic pricing model on over 190 vessels, which automatically optimizes prices to maximize revenue. Pretty smart. But the bearish perspective is just as important to understand. There is extreme concentration risk here. Their entire business model is tied to just a handful of major cruise lines. Furthermore, they are highly sensitive to macroeconomic travel downturns. If there's a global recession and people suddenly stop cruising, OSW's revenues are going to take a direct hit. It is a cyclical business at the end of the day, and you have to be totally comfortable with that reality before jumping in.
So, factoring in all of those elements, the current analyst consensus target sits at $28.60. That represents a roughly 20% upside from current levels, and it's heavily driven by an expected $1.03 billion in full-year revenue for 2026. The street is clearly betting that the strong tailwinds and that asset-light model will overpower the macroeconomic risks.
So what you should really take away from all this is that OneSpaWorld offers a uniquely visible growth path with just an incredible competitive moat. Are you ready to add this floating toll booth to your watch list? Did this 5-model analysis prove to you that the biggest hidden moat in finance is currently sailing in international waters? Let that sink in. Thank you so much for joining me on this explainer. Keep learning, keep analyzing, and I'll catch you in the next one.